Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining me. And with the end of the financial year now gone, I'm looking for companies or stocks set to do well. And in 23-24, it looks like the year that artificial intelligence could have a very big impact. Jun Bei Liu of Tribeca Alpha Plus will start off with quality companies that the markets have beaten up that she thinks will rebound this year. Then Anthony Doyle of Fire Trail Investments, he wants to look at, should you invest with all this recession talk around at the moment? And then Matthew Michalewicz, arguably the greatest expert on artificial intelligence in this country, is going to look at what AI might mean for the way you invest and what stocks might look like good value as a consequence of what he knows about AI. And finally, Marcus Bogdan of Blackmore Capital, who also manages the Switzer Dividend Growth Fund. He looks at the stocks he's dumped and the ones he's buying for his portfolio. So there's plenty of insights there. Let's kick off now with Jun Bei Liu of Tribeca Alpha Plus. Thanks for joining us on the show, Jun Bei Liu.
Thank you for having me, Peter.
Okay, what's your feeling about the market now? Because it's a new financial year. What do you think is going to happen between now and Christmas?
Look, I do think, well, first of all, we will have a whole raft of downgrade coming this reporting season. We're already seeing some downgrade from consumer companies. There's just a little bit more.
It's logical, isn't it?
Exactly, but that's not bad news because for share market to move definitively higher, we have moved higher, but last 6 months was all about defensive companies, structural growth businesses. But next 6 months, we do need the earnings to be lower, and so that the investors can then rebase their earnings expectations and then grow from there. So it's a good thing if we can get the earnings to more realistic levels. So after that rebase, we do think the market is tracking higher, particularly for some sectors such as more exposed to the China, because the China story will begin to build because all these stimulus will start to come through. Plus, our healthcare will do a little bit better. Hopefully interest rate by then should work its way through the consumer. And looking ahead into the second half of 2024, we potentially be looking at some interest rate cuts. And so that will really fuel the optimism for the share market.
Yeah, and let's face it, you can't expect Harvey Norman and JB Hi-Fi to shoot the lights out when interest rates are rising at a rate of knots.
Absolutely, but if you look at the share price performance, share price actually have gone up since the downgrade of Harvey Norman's downgrade, and same as the JB Hi-Fi. What it says to the investor is that share market will always look forward to 12, 18 months. So, and these companies have been oversold quite significantly because of the fear. Come downgrade when the result comes, share price potentially go a little bit lower, but not much more. So, we just at the moment in that in-between period before people can, pile into those stocks, but certainly the sellers are pretty much gone.
Okay, let's just blow our mutual trumpet. Around November last year when Zero went to 64, you and I, we stuck to our guns.
We did.
And I'm glad we did. It's come good. It's okay, that's blowing the trumpet. Now, get it right again. What's the next company? One company you've been blowing the trumpet for has been IDP Education. Is this a company worth sticking to and believing, or have things changed?
Look, absolutely. It's still a business that is going to be very exposed to the increase in student numbers. And so far at the moment is looking very, very strong. Now, the English testing in terms of the Canadian markets had a bit of a hit, but net, we do think the overall student placement business is going to be the bigger driver, and the pent-up demand is enormous out of Asia. So I will be sticking to that one. And the company has very strong balance sheet.
Okay. I know I sent some companies that were very small, and you basically said, too small for me to have an expert view on. Fair enough. Okay, let's just make this interview sticking to the guns. A2 milk has
Absolutely.
Do we stick to A2 milk, or do we go sour on it and get rid of it?
No, this is absolutely sticking to the core. Yeah. It's quite interesting that the investors couldn't look past the some of the near-term headwind, which is return of students. You need a more Daigou channel so that the English label can move. The company even received its Chinese label sort of product approval as well. well. Share price hasn't moved, with a very strong balance sheet, with next year's earning looking at quite a significant growth, just simply recovering from the COVID impact. This company is almost one of those no-brainers, just like Zero at under $70. I think when Zero was, I think at the time we said the buy mark for Zero was $80. It kept going lower.
It went to 64. I remember.
That's right. That's right. And then we kept buying more and more. But that's what it is. Market is irrational. Market do not want to sit with any uncertainty. They much rather pay more.
They're short-term irrational, but long-term they kind of get it, don't they?
They will, absolutely. So people are sitting there waiting to buy these things. So they're waiting for any positive news, which is the result. Companies already talked to what the result might look like. So net, your bad news is pretty much in the market.
Yeah. But look, our brilliant argument that we're both putting here together does rest on the fact that the business has to be a quality business. So we said Zero is a quality business worth sticking to. You kind of believe IDP Education is a quality business, hasn't had probably the same track record, but still quality business. A2 Milk, we used to think it was a quality business, and you probably still think it is, and that's why you're sticking with it. Okay,
Absolutely.
so it's 3 ticks. Let's move to a company now, and I'll ask the question: is it a quality business? It's been slugged. I've bought it recently when the price was really low, because I thought even if it only goes up another 10 or 15 cents, it's going to be okay.
Yeah.
The company's Tyro. Right? Now, is it a quality business? We know a private equity mob wanted to pay $1.60 for it, and then went down, I think, below $1. But what's your view on Tyro? Is Tyro a quality company, or it hasn't proved itself?
Look, it's a quality company. I think it's, and it works so well as a part of a bigger business. That's why the takeover offer. Now, obviously for investors that was in there, a little bit disappointing that didn't come through. I almost feel certain there will be one other bidders coming through. Now, in terms of the near-term earning, I tell you why the investors couldn't sit there at the moment is because they worry about, the company is very exposed to the restaurants, the SME cafes and restaurants. So maybe in a slowing economy, things will slow somewhat. But look, for this company, they're still gaining share, against the big banks and the like. So net, I think for this business, things will still go pretty well, and it will be reasonably defensive across the current environment.
So I guess what you're saying is, you've got to be careful if the share price goes very high, but at current levels, it's probably worth a punt. And we're not saying this is going to be a definite winner, but it's probably worth a punt. You say
absolutely, for a small position.
Yeah, for a small position, exactly. All right, so I've been throwing you some ideas. Bring up some other companies that fit that bill that you think are quality. The market's given it a bit of a slugging, but you think over this upcoming financial year, it should actually prove the market wrong.
Yeah, absolutely. So there's actually quite a few of them.
I'll give you two of them.
Yeah, there's a lot of them. I'll give you two of them. One of them have been talked about for some time, which is Treasury Wine. Look,
I've often thought you've got a drinking problem.
Yeah, that's right. Like that's all I ever do. I try very hard to boost their sales. Look, at Treasury Wine, very exposed to the China reopening thematic. Company trading on less than 20 times earnings for a double-digit growth, for 12-13% growth for the next 3 years. Things are going very well for this company. Strong balance sheet now, and China, if they do come out and change the tariff that they put on Australian wine, this could be a meaningful upside. 15-20% you should see it in the first few days. So very just there's a lot of optionality with this business, premium business, premium label, like a global luxury brand.
True. And luxury is doing really well.
Absolutely. You compare this one with other global luxury luxury beverage makers. This company has really trading at a discount to those luxury makers ever since it lost to China as the core market. This company has done incredibly well. 2 years ago, when tariff was put in place, China was 30% of its business. And then 2 years on, with the tariff, they essentially lost China. And the earnings is actually higher than what it was before China. Just incredible business.
And I guess the bottom line is, because China was such a good customer, they probably didn't work as hard in other markets. But once they lost China, they had to market elsewhere.
Absolutely.
Yeah.
And now they expanded the market. And so not only filling the hole for the Chinese market, they grew on top of it. So if the China does come back, of course, they're not going to pull the rug and, pull all the volume, but they're going to just gradually grow, broaden out their customer base.
Okay, you made the point.
Yeah.
Treasury wires.
Sure.
And what's the other one?
The other one is a smaller name. It's called Jones Lang. JLG is the code.
Yeah.
So they a little, not a little. It's actually been around for 60 years. It does repair jobs for insurance companies.
Oh, this
has
is an interesting
long-term
one.
contracts.
So the name again, it's Jones?
So Jones Jones Lang Group.
Jones.
Yeah. Jones Lang. Yeah.
Okay.
My Chinese pronunciation.
Okay, well, what's the ticker code?
JLG.
JLG.
That's right.
And this is a really interesting business.
Absolutely.
Tell the audience what it does.
It's fascinating. So all it does, it just provides repair jobs for insurance companies. So when you make a claim with your insurance company, they just call up these guys and say, fixing up the roof, fixing up all of that.
Yeah.
Now, it is actually the largest here in Australia, been doing it for 60 years and have big contracts across pretty much all insurance companies here in Australia, doing really well. And so not only they get the, bits and pieces from mum and dad's issues, so it claims, they also do natural disasters. So whenever there's the roads being damaged or, cyclone through Queensland.
So climate change is good for them.
It's a climate change linked businesses. So ever since it listed, maybe 7 years ago, the pipeline for natural disaster just getting bigger and bigger.
Yeah.
And every time when they get a contract for a natural disaster fixing, it's at least 2-3 years because it takes that long to fix up those infrastructure. So the pipeline is getting bigger and bigger and bigger. This company every year on average upgrades its earning by 4 or 5 times because no one puts those natural disasters sort of earning in their forecast, even though it's almost guaranteed.
Yeah, and I guess what they've done in the old days, an insurance company sent an assessor out, then the insurance company had to get a builder, or the owner would get a builder, and the builder would have to look at what was being paid by the insurance company. These guys have sort of cut the middleman out.
That's right.
Or cut the other man out, but they're the middleman and they're doing the repairs as well.
That's right. And then they make the insurance company feel very safe with these guys because they've been doing it for so long for them. A much easier quote, and it's cheaper for the insurance companies, and it's safer for the individuals, and it's easier. Literally, insurance companies say, "I'll fix it for you."
Yeah, and they've got sort of a uniform quality rather than disputes.
Absolutely.
Like the idiot carpenter came in and didn't do a good job, and the insurance company has to fight. Makes a lot of sense.
They just expanded into the US market as well, and it seems like the market dynamic is almost similar to Australia, and then expanding quite well. So this company is incredible business, and recently
you seem so excited.
I'm very excited about this one. Yeah, that's right. I'm very excited about this one. It's it's not often talked about, and then more recently, because market a little bit impatient and the like, it upgraded its earning by 10%, and but clearly consensus expectations was already there, so share price went down on the basis of that. And now it really presents this incredible opportunity of a company that's earnings something like 60-70% guaranteed for the next few years. At the same time, still growing quite significantly. On an earnings multiple that's probably cheaper than Coles and Woolworth. And with the earning that's very defensive, it's not related to economic activity and the like. So,
climate problems come whether the economy is up or down.
That's right.
And governments have to help out.
Absolutely.
Great stuff. Great to see you again.
Good to see you. Thank you.
Let's hope this year. I guess when you look at the financial year performance, it wasn't bad, was it?
No, it wasn't bad at all. So for a lot of investors who are talking about the doom and gloom, they really missed it. So that's the thing with share market. Whenever you see a volatility or sell-off, it's usually followed on by very strong performance. That's why equity market is a great, asset class. So for investors, really, you want to use those sell-offs as buying opportunity rather than be fearful.
Yeah, exactly right. Good to see you.
Thank you very
Jun
much.
Bei Liu of Tribeca Alpha Plus. Joining me now is Anthony Doyle of Firetrail, and I think he's a highfalutin title like equity strategist or something. What is that highfalutin title?
Head of Investment Strategy, Peter.
Well, it's even bigger than equity strategy. Investment strategy.
Yep.
And that's why I've got you here, because I do want to know what you're feeling for the next 12 to 18 months. You wouldn't be surprised to know that I'm reasonably positive, even though there's talk of recessions. I think market-wise, there's a lot of opportunities.
Yeah, definitely. Particularly outside, for the global equity market, outside of those mega cap tech names that are household names now.
And have killed them already.
Yeah, exactly. And they're up over 30% this year.
Yeah.
And they're largely responsible for the entire rise of the US S&P 500.
Yeah.
So
if you take them out, it was zero.
flat.
Yeah.
Flat.
Yeah.
So, I mean, we're looking further afield.
Yeah.
We're very comfortable with our exposure in that space. In
Yeah.
the US, we own Alphabet, which is Google. We also own Microsoft. But we're looking further afield. So more in the mid-cap, smaller to mid-sized companies.
Will there be growth in tech-oriented type companies?
We're investing both in growth and value names.
Yeah.
So we think it's appropriate and it always makes a lot of sense to be diversified. And a good example, a lot of people are talking about the rise in mega cap growth names this year, particularly those with exposure to artificial intelligence. But the US home builder index is up 29% this year. And so why is that? We're economists, Peter, and would have said if you hiked rates from 0 to 5%, the housing market would absolutely collapse in the US, and it hasn't. The reason being interest rates have risen so quickly that sellers, they don't want to remortgage to buy a new house, so they're staying in their existing house.
And renovating.
Renovating, and so we've seen home builders benefit, but also, so a good example in our fund is a company named Tektronic. They make power tools, Ryobi, Milwaukee Tools, they own Hoover, and so that's been a good contributor to our performance this year.
Classic picks and shovel type company.
Exactly, exactly. So looking further afield, outside of those really expensively valued technologies, they've rallied hard, they've run strongly. You have to have some pretty heroic assumptions to think that they can continue on that trajectory for the rest of this year. So we think looking beyond that.
Anthony, what's your view on a US recession, which of course 6 months ago a lot of people were really hot to trot to say there's going to be a recession coming. Those people, I guess, have forgotten their forecasts then, and they are pushing it out.
Yes.
But what's your view of when US might go into a notable slowdown or something like a mild recession?
Yeah, so it's the most telegraphed recession that we've ever seen. I think you can also apply that to Australia. But in terms of the US, certainly it has been a very rapid increase in interest rates there. And the market and the Fed are telling us that they might potentially do another 0.5% in the next couple of meetings. So undeniably, interest rates are biting in terms of those companies that are more leveraged, they have higher debt, or smaller types of companies. So if you believe the US Federal Reserve's forecast for the unemployment rate, they think the unemployment rate will rise to 4.5% from 3.7% currently. Now, throughout the last, since the 1950s, any time the US unemployment rate has risen by 0.5% or more, there's been a recession. So the US Fed is essentially forecasting a recession. Now, what's surprising central banks all over the world is just how strong labour markets are. And that's the result of, I think, us being cooped up in the COVID-type lockdown scenario environment. We're seeing a huge shift in spending from spending on goods, stuff, to services. So we've seen the goods part of the Australian and global economy, those companies have been hit very hard. We've seen inventories build. But on the services side, so you need to employ people, you want to go and get a haircut, you need to employ people to do that, remains very robust.
So all those punchy people out there getting their nails done and massages and all that sort of stuff, saving the economy at the moment.
Travelling, exactly. And because people built up, households built up savings over those couple of years of lockdown, interest rates are biting. They are. We have seen that in the Australian economy in particular, particularly some of the listed names that you're familiar with, Peter. Harvey Norman, Best and Less, JB Hi-Fi, coming out with profit downgrades. Certainly, that's a scenario that we're seeing in other parts of the world as well. Yeah.
So, when you look at it, then, are you saying to yourself, There's 1/3 of Australians, senior Australians, have mortgages, but 40% of them have been on fixed rate home loans. And it's usually 15%, but since COVID, it's 40%. My feeling is the second half we're going to see a substantial drop in spending from all those people who are forced to go from fixed to variable, and that should vindicate that the Reserve Bank has done enough.
Yeah.
What do you reckon? As an economist, not as someone who has to guess the Reserve Bank to be right, but as an economist, and given the history of this being probably the fastest rise in monetary policy you and I have ever seen.
Modern era, yeah.
Do you think the Reserve Bank really is taking big risks increasing interest rates?
Yeah, I think what's really interesting is the dynamic of the barbecue conversation in the Australian backyard, which has shifted from house prices to, around the conversations that I have with my friends and the parents.
And you're a barbecue king.
Yeah, of course. Yeah,
barbecue king.
I love the smoking on the barbecue. I've got a big green egg. The low and slow cooking.
And you're not a banker, so you can hold these things. Yeah.
But it's gone from house prices to the cost of living and how expensive it is to fill up your grocery cart these days. So
and Dr. Phil Lowe is nearly as popular as Vladimir Putin at the moment.
Oh, he's about as popular as the Australian wicketkeeper in London at the moment. After that stumping last night, which I found very amusing from my ex-colleagues in London texting me. Yeah. But certainly the RBA are treading a very fine line, and we have the interest rate meeting tomorrow here in Australia. Most economists think that they will go again and raise by another 1/4 percentage point, and then potentially again. So the interesting dynamic here at play is that Phil Lowe, he still hasn't been reappointed potentially for another 3 years. So we may see a new governor, and being a career economist at the Reserve Bank, does he want to be known as the guy that let inflation become embedded in the Australian economy? I can guarantee he probably doesn't. So we've seen him become what we describe as more hawkish as economists, a bit more tough on trying to get inflation back to their target.
Yeah, that's right. I think he could easily do that for that reason. If he believes his job's gone, well, he may as well go out with a blaze of interest rate rising glory.
Yeah, let someone else clean up, after him.
Yeah, well, I guess the next government has a benefit of saying, I'm going to cut, that guy got it so wrong. I'm going to cut now.
Yeah, exactly. Particularly if the economy slows to the extent that it could potentially could.
All right. If the economy does go into a recession, but it's more like a technical recession, 6 months of slowdown, and some businesses like the Harvey Normans and JB Hi-Fi copying it, but the services business is still doing okay, like Qantas and Virgin and whatever. Do you think the stock market still can rise, in a sense, by picking out the companies that are doing well?
Yeah, there's an old cliche, Peter, that we've heard many times. The stock market is not the economy, and the stock market is forward-looking. The equity market is forward-looking. So some of these strange things that are going on at the moment, you raise interest rates and house prices are rising. It doesn't make sense. Yeah. And it is, a multitude of factors, including demographics and immigration and tight housing supply as well. So for us, when you are investing in the equity market, when you are investing in the stock market, you have to take that medium to long-term view. Very difficult to say where the stock market will be at the end of the year. Very difficult to translate macroeconomic factors into stock market outcomes. One of the most difficult things you can do as an investor is make a decision to go into cash or to invest into equities. So we think being invested throughout the cycle, but also, a sensible strategy is dollar cost averaging into the market for when you get that turning point, and having that long-term perspective. When you have that, you can sleep pretty well at night, ignoring the noise of newspaper headlines.
Okay, one last thing, I'll give you a chance to plug who you work for. If someone wanted to play global markets to get some exposure, most of us, as you know, are heavily invested locally.
Yes.
What's the best fund that you guys have for chasing global returns?
So we have a fund listed on the Australian Stock Exchange.
Yeah.
The ticker is S3GO, and it's named the Firetrail S3 Global Opportunities Fund.
3GO.
3GO, yeah. So we invest.
Sounds like a rock star TV show, right?
So
3GO.
it's there's no minimum investment. You can own it next to your BHP and Cochlear shares and CBA shares. It's very liquid, daily dealing, liquidity, and as I mentioned, no paperwork as well. So currently the unit price is around $4.99, which I believe is just a little bit less than the price of a coffee today. Did
I say you could do such a big plug for you? Anyway.
Less than the price of a coffee for exposure to our very best around 30 global companies across value. So companies like financials and energy style companies such as renewable diesel, for example, and then growth companies. Some of those names I mentioned earlier, Microsoft, Alphabet.
You won't get a chance to plug for the next 3 or 4 interviews after that lot. Mate, great to see you. That's Anthony
Peter.
Doyle from
Thank you.
Firetrail. Firetrail Investments, is it?
Firetrail Investments. Yeah,
exactly.
That's right.
Thanks for coming, mate. Now is Matt Michalewicz. He has a company called Complexica. This is a pioneering artificial intelligence company. I think one day will prove to be one of the most well-known artificial intelligence company in Australia, and one day it'll be listed. Matt, thanks for coming on the program.
My pleasure, Peter. Thanks for having me.
I made some big calls, but between you and your father, you've got great traditions in the area of artificial intelligence. Is there a company in Australia at this point in time that you know of that might not be your rival? I don't want to put your rival up, but there's a company that is really leveraging of artificial intelligence and it's helping that company?
Do you mean from a customer side or more from suppliers?
Customer or productivity or profit side?
Yeah, I think if you look at customer side or generally non-vendor, non-software vendor side, it's usually the bigger entities that really leverage this kind of technology. And it's not dissimilar in other countries, big banks, big telcos, big retailers. So same in Australia, look at the big 4 banks, you look at Telstra, look at Woolworths, etc. You'll see a very strong investment into machine learning, artificial intelligence, into all aspects of their business and how they leverage it and use it. So that's not dissimilar from other countries, and it's the same in Australia. From a supplier side or a software vendor side, it's much less so because Australia just generally hasn't been well known for a tech software pioneering in this particular space over the years versus Silicon Valley or other areas around the world.
But this is the supply side is where you're coming from, isn't it? At the end of the day, you want companies, and there probably will be some big listed companies one day. I'm not sure who you're looking after now, but there are companies that are going to see that there are supply/cost benefits of tapping into this new world of artificial intelligence.
My view, Peter, is that AI will become as ubiquitous as mobile phones or as personal computers or as spreadsheets or anything else. So as you know from our previous conversations, I've been in the area of AI professionally for 25 years. I've been running tech companies in this space, and my father's been an AI scientist since 1982. So it's 41 years. So it's a very, very long period of time where you can see a technology come from obscurity, from the fringes, from completely being
sci-fi movies.
Absolutely. Yeah. The Terminator came out in 1984. So 2 years even before then, my father was working in this space, and it was something that people laughed about. It was very sci-fi-ish. And now it's on every newspaper, every person's lips. Everyone's talking about it. Everyone's intrigued about it. Companies are trying to inject it into their business, just like in the late 90s, companies were trying to inject .com into their business name or into their operations. So it's become very fashionable and very, very widespread. And just like everything is online today, you can buy things at the click of a button, search for knowledge or information at the click of a button. AI will be very much the same. It will be embedded in our devices. It will be embedded in our software applications. in even the hardware that we use, and won't be the thing that we talk about in the way that we talk about it today. We might move on to something else that's exciting, quantum computing, who knows?
Yeah. So at the moment, Matt, a lot of people are hoping to find those companies that are going to really get the big bang benefit from AI. But that's sometimes looking like looking for a needle in a haystack. But it seems to me you're saying that this will become so usable by all businesses from small to big, because it will be incorporated in our mobile phones, inside our software technology we use in our businesses. I'm asking myself the question, and I'm going to ask you the question more importantly, is the world, and particularly the Australian economy, and probably especially the US economy, going to get an enormous productivity uplift that we have never seen before because of it?
I believe that will be the case, and I think, and we've talked about this before in terms of displacement of jobs, automation of jobs, etc. If you look through history, advances in technology are actually job creators in the end. So I think, and my personal belief is that there will be a very, very significant lift in productivity. Things that might have taken days or weeks can turn into seconds. We see that in some of our own customers, where it takes a person to research some particular aspect of their operation. Where can they potentially lose customers, gain customers? Where can they reprice, etc.? Those are exercises that take days and weeks for people to do, that all of a sudden take minutes to do. So this isn't, again, science fiction. We see that in our own customers. But all of a sudden, if you unleash that at scale, within consumers, within every aspect of a business or a staff member's life and operation, productivity can grow at alarming rates, in incredible rates. And all of a sudden, companies will want to tune and adopt this technology, which will create jobs, will create specialists, will be more of a demand for people that understand this technology, and so on. So yes, I believe that there will be a very, very significant jump in productivity. And at the same time, I think there'll be a very significant surge in job creation, with companies trying to harness this technology to use it, adapt it, harness it for their own purposes.
But you've kind of implied that there can be a transitional period where some jobs which will be replaced, ultimately more jobs will be created. And I'm just wondering, and this is really in the modern context, you must have CEOs of banks saying to themselves, these so-and-sos won't come to work. We want them here, but COVID has changed their attitude. Okay, let's just see if artificial intelligence can replace those so-and-sos. Do you think, and I'm not asking you to say whether you know, but do you think that's highly possible that there are CEOs saying, well, if they don't want to come to work, we'll try and find some alternative solution to them?
I absolutely believe that that's the case, but not because someone doesn't want to come to work or does come to work, but simply because the mandate of the CEO is to really maximize shareholder value of an enterprise. And if you can automate tasks, if you can create the same kind of output with less labor inputs, or you can do it faster, that just enhances the value of an enterprise in terms of the value to shareholders. So I think this is a recurring theme in all areas of business or of society, not necessarily tied to whether someone comes to work or not. And to your earlier point that there's a transition, absolutely. Look at when the calculator came out, something super simple, or the first computers. They could, without a doubt, do arithmetic much, much, much faster than human beings, without a doubt. So no sane person would be able to say, well, this isn't going to impact anyone's job. If you're involved, like that movie about putting men on the moon, that's that NASA movie where it had people that were called computers doing arithmetic, etc. If your job is just to do arithmetic, that job will certainly be automated, but it creates an entire layer of jobs above that on what can be now done if the arithmetic is automated all of a sudden, and you can do it. So absolutely, it's a very, very similar kind of phenomenon happening now. I see my kids creating ads, whether it's to do a listing for something on eBay or listing for an Airbnb property, etc. How did you come up with that? Oh, I asked Chat GPT to do it, write the description, and then I modified it, etc. So all of a sudden, you can see this immediate impact in especially the younger generation, where they left something that, again, write a description might have taken them half an hour to do, whatever period of time, now takes 2 minutes, as an example. So that's immediate productivity, immediate gains. And if your job was to be a copywriter and create advertisement copy for properties, etc., again, that is going to be automated along with a lot of other things, but that's going to enable a whole new class of jobs that rely on that as an input to what they do.
Okay, Matt, so why is it going to take you at least, explain to my audience the crazy timing that you've got for the listing of Complexica? This is the last question I'm going to ask.
Coming from a scientific family, you would appreciate that the importance of numbers is something that has always been emphasized to me. Both of my parents have PhDs in theoretical math, so numbers and importance of numbers was always hammered home to me from an early age. And next year is a very significant year. One is the year of the dragon, which happens every 12 years in the Chinese zodiac. And I was born in the year of the dragon. So my last company was sold in the year of the dragon. My first AI company was created in the year of the dragon. I was born in the year of the dragon. My father was born in the year of the dragon. So there's just this family tie and significant event occurrence in our timeline to this particular year. And secondly, probably more importantly, our company was incorporated on a very historical date, July 30th. I think it's one of the most important dates in international history of the modern world, and that's Arnold Schwarzenegger's birthday, July 30th. And so on July 30th next year, which, by the way, I've checked, Peter, that's a Tuesday, and the ASX is open that day.
Yeah.
It will be our 10-year anniversary as a company. It will be Arnold Schwarzenegger's birthday. It will be the year of the dragon. What a fantastic day to list. I can't think of a more favorable omen in terms of numbers.
Yeah. And I should say that before you realized that you weren't quite as big as Arnold Schwarzenegger, you were planning on being a world champion bodybuilder until your father probably said, "You've got other potential, son."
Oh, he said it before I started. I read a big book on when I was, I think, 15, that Arnold Schwarzenegger had written, the Encyclopedia of Modern Bodybuilding, and I didn't want to go to uni. I wanted to be a full-time bodybuilder, and my father said, "Look, just in case that doesn't work out, the very, very, very unlikely event that you're not the next Arnold Schwarzenegger in bodybuilding, why don't you just in parallel sign up at the uni, enroll in some business classes, one class a semester, so it won't cut too much into the sleeping in the sun, the milk drinking, the meat eating, the 4 hours of training a day. And if it doesn't work out in bodybuilding, you can then crank up your studies at school, get a degree, have a normal life like everyone else." And that turned out, Peter, to be very good advice.
Well, I must admit, I remember July 30. I hope you come to Sydney and the ASX to ring the bell, and because the next day after is Maureen's birthday, so we all can go out for a celebratory dinner. Great to see you, mate. And,
likewise, Peter. Pleasure.
And I will remind people one day that there's a potentially great company in Complexica listing in a year's time. Good to see you, mate.
Absolutely. Take care, Peter. Thank you.
Yeah. That's Matt Michalewicz of a company called Complexica. Thanks for joining us, Marcus.
Really great to be here.
Now, in June, you've told me before we go on air that you've made a few changes to the portfolio. Talk us through what changes and why.
What was very important when we were making the changes that we kept the dividend yield as high as possible for the income fund. So we made two changes. We sold Suncorp, which was one of the strongest performers in the portfolio over the last year, benefiting from particularly on the insurance side and higher interest rates. But they were at sort of near record levels, and we decided to lock that profit in. And we also sold Atlas Arteria, which is a European and US toll road. And we were slightly concerned there with the level of debt and the fact that interest rates have continued to move higher. And we believe for both of those stocks, we could add to our existing holdings and actually improve the overall dividend yield and include some more franking there. So we added to Metcash, National Australia Bank, and Rio.
Okay. So why do you like Metcash? Its rivals haven't been, shooting the lights out lately in terms of the share price, but I guess you have the expectation that its underlying profits going to be pretty good.
Well, they reported in the last week or so, and the three key parts of that business are the food wholesaling business, supermarkets such as the IGA group, the liquor business, which is independent liquor, and the hardware business. And each of those results were encouraging. And what we do like about Metcash is that it trades at a significant discount to both Coles, Woolworths, and Endeavour. It trades on a price earnings ratio of about 13 times compared to sort of the early 20s for the bigger consumer staple companies. And it's a dividend yield of over 5%. So it's a higher dividend yield as well. So strong operational performance, very, very good discipline across that portfolio. And we very much like the valuation of the company.
It's a big endorsement of Shane Jacobson, isn't it?
Well,
I am joking, Marcus. Shane Jacobson is the comedian who does all the ads for IGA.
Okay. Well, I think they are attracting those local communities, and I think they are doing that particularly well. They did very well in COVID, but I think some of those gains have been more long-lasting as people have stayed around community shopping. Okay.
Are you showing your Melburnian bias in jumping on board NAB?
Possibly, but the three retail banks outside of CBA have really struggled in terms of their share price, but we don't think that the valuations are quite attractive at these levels, and the dividend yield is around 6%. So we do like NAB because it has less exposure to mortgages and a greater exposure to sort of business lending, and we feel that the underlying share price has underperformed quite significantly, and there's some value there.
Are you still a big holder of CBA?
We're still a holder of CBA. They trade at a significant premium and have always traded at a premium to the other three retail banks. They've tended to execute more consistently, and they've certainly got a better technology platform than the other three. But probably the greatest value is probably in those others, particularly NAB and Westpac at this point in time.
Okay, so what do you think is going to be the stellar performer in the portfolio for this new financial year, given the fact that you primarily anchor your analysis on good dividend payers, but you're happy to get some capital gain as well? What stock do you think has the most potential upside?
I think if we look at the stocks that are about to improve their earnings quite significantly over the forecast period, and that would certainly be in health and healthcare. It's less subject to the economic nuances that we're seeing here and the pressures there. And we do believe that there is going to be a recovery in healthcare. It's already happening, but we do believe that tail is quite long. And so one of those companies that has really underperformed, particularly in the last quarter, has been Ramsay Healthcare. It's not a big dividend paying stock, but we do believe that the trajectory of earnings is much improved. And we do like the fact that David Thodey, from the former CEO of Telstra, is becoming the chairman of that group. And I think that that will release some significant value in the group over the next year.
Yeah. I must admit, I included them in my Switzer report today on stocks that look, quality companies that have been beaten up by the market. One last theme. I also made the point that even though I don't expect in the short term, neither of these two companies will rebound soon, but ultimately it's great to pick quality businesses that are out of favour for the eventual rotation. And the eventual rotation I had for these two companies was one day interest rates will fall. And some of the retailers who are unpopular now and are also good dividend payers will come back into favour. For example, JB Hi-Fi and Harvey Norman, because they are historically very good dividend payers, but you wouldn't want to buy them now, but probably in 6 months' time, if interest rates look as though they're near the top, would they be back on your radar screen?
I think the underlying philosophy that you're referring to around buying high quality companies when they're out of favour has absolute merit. And so both of those are obviously subject to consumer discretionary pressures there. And I'd also include Premier in that group as well as the three ones to very much keep an eye on. Each of them have got strong balance sheets. They've got, very good histories of paying solid dividends to investors. And they are absolutely on the watch list in terms of eventual recovery plays.
Yeah, great stuff. Marcus, thanks for joining us. See you in a few weeks' time.
Pleasure. Thanks, Peter. Cheers.
It's Marcus Bogdan of the Switzer Dividend Growth Fund and also Blackmore Capital. And that's the show for the night. Thanks for joining us. Don't forget, if you want more insights, become a subscriber to the Switzer Report. Go to switzerreport.com.au, and I look forward to welcoming you to our little fraternity of investors. Thanks for joining us. I'll see you next Monday.